Happy Wednesday. Welcome to Yahoo Finance Live. I'm Julie Hyman. That is Josh Lipton. We're here at the New York Stock Exchange, and we're going to bring you the big three at 3, the big three stories to watch at 3 p.m. Bond yields pulling back from the 16-year highs that we saw on Tuesday. The move coming after weaker than expected jobs data from ADP. We're going to break down how the recent surge in yields could impact the Fed's goal for a soft landing.
And the battle for House speakership is on. The House needs to elect a new leader after Congressman Kevin McCarthy was ousted from that role, but it may not matter who wins that race as lawmakers face another deadline to fund the government. We'll have expert analysis on what this all means for the market, economy, and your money.
And 20 days and counting, the UAW strike rolls on. GM estimating the cost of the strike to be about $200 million in the third quarter. The company filing for additional credit of up to $6 billion in a case of prolonged troubles. And Ford is upping its wage increases in a new contract proposal. What will the UAW say? We're going to break down the road ahead for the automakers. Let's get you up to speed on the market action. In the meantime, we are not seeing big moves unless you're looking at the Nasdaq here, sort of the sneaky winner here today. We were seeing a mixed picture earlier on. Right now, the Dow eking out a small gain of about 17 points, the S&P up about 0.5%, and the Nasdaq's the winner on the day here. As we know, large cap tech has taken a hit at times as we've seen those yields creep up. So a little bit of relief today as yields have gone down. And speaking of which, let's take a look at those Treasury yields as we see a little bit of a come down from some recent levels after the 30-year breached 5% for the first time since 2007. There's not that much relief here. We're talking about 6-7 basis point decreases across the yield curve, 4.88% on the 30-year, 4.74% on the 10-year. Those are still relatively high levels, but nonetheless enough to give a little bit of breathing room to stocks today.
And we are also checking in on oil. OPEC Plus maintains its current output reduction strategy as inventories, the largest U.S. storage hub, sees its first increase in 8 weeks. Meanwhile, J.P. Morgan pointing to the beginning of demand destruction for oil. And beginning there, Julie, just on the demand picture. So J.P. Morgan's basic argument here is, all right, demand destruction has begun. Consumers are going to their local gas station. They're topping off the tank. They're alarmed by what they see. I'm one of those people topping off the tank who's kind of getting nervous. And given that Q3 spike we saw in gas prices, their point is no surprise. Consumers get nervous, and that starts to dampen demand.
Yeah, I mean, that does seem to be at least what is starting to happen according to that thesis here. That inventory increase was interesting. The biggest increase that we saw in 8 weeks in Cushing. Some of the drawdowns in Cushing had been one of the things that have been fueling the increase in oil prices. We talked earlier in the week about also refinery maintenance that causes shutdowns at the refineries. It doesn't look like that is necessarily playing into it as of yet. But nonetheless, all of these cross currents on oil, it feels like, though, like with treasuries, yes, you were seeing a pullback in oil prices here, not just because of the things we mentioned, but also because of broader economic concerns. Is it enough to say all clear on oil prices? Doesn't feel like that yet, just like it doesn't with treasuries. But nonetheless, again, a little relief today, perhaps.
And then seeing, of course, Saudi Arabia and Russia maintaining those supply cuts as well.
Exactly. So all of that may be creating a little bit of a floor under oil, even if it's, not necessarily causing gains in today's session.
All right, well, moving on. The race is heating up among House Republicans to become the next House Speaker. House Majority Leader Steve Scalise and Congressman Jim Jordan are the first to throw their hats in the ring. But our next guest is raising the concern that no matter who takes the gavel, it will be a difficult task to get consensus on key issues, including spending, as the government faces another threat of a shutdown next week. Joining us now is Jeanette Lowe, Strategas Securities Policy Research Managing Director. So, Jeanette, thank you so much for joining us. The race for the speakership is on here. Steve Scalise, Jim Jordan, do you have a horse in that race? Do you have bets you would place? And I guess the bigger question, would it actually matter here if it was Scalise or Jordan? Big differences between those two?
So there are differences that with terms of who may be a little bit more conservative and who might be a little bit more moderate and who might be able to get more of the votes. from either side within the Republican caucus. But the issue is that, right now, McCarthy was the person who probably could have gotten the most votes out of the Republican caucus. So now one of these other individuals has to figure out how they can wrangle the most votes to then ultimately win that speakership. I think there are concerns on different sides about certain issues. Maybe Scalise still has, going through cancer treatments, and you have Jim Jordan being a little bit more conservative. So I think that people are going to have to figure that out. But for us, the bigger issue right now is, that Speaker McCarthy was deposed yesterday. The House is not going to come back until next Tuesday, which means an entire week is now being lost, where we're not actually even working on any of the budget issues that were going to potentially cause a government shutdown 4 days ago. And we don't necessarily know how easy this speaker vote may be. It could be that it's quite chaotic, similar to what McCarthy faced in January. And that dysfunction is starting to play into the markets, and we're starting to see people being a little bit more worried about whether or not policymakers are actually able to keep the government functioning.
That is definitely appears to be a concern. I mean, so what's the answer then to that? Are we going to get that shutdown, especially with that lost time, and especially with the pressure from the right wing of the party that caused the McCarthy to be removed in the first place?
Right, exactly. So there's nothing that's really changed in the Republican caucus except the fact that McCarthy is no longer the head of it. So whoever takes over as speaker really still has to wrangle what to do with this very tight majority, how to wrangle with the moderate concerns with the conservative concerns, and then figure out how to go forward from there. So there may be some horse trading to actually get the votes for the speakership, and maybe that will ultimately get us a deal that comes through. If we think back to what happened in 2015 when Boehner stepped down as speaker, Paul Ryan actually was able to pass a budget deal that Boehner never was able to do so. So a new speaker may come in with some political capital and may be able to move us forward. But at the same time, what we're seeing right now doesn't give us a whole lot of confidence as we're looking forward to November 17th and the fact that we might still have another government shutdown. At that point, we're not really seeing any change yet on how do you solve the budget issues? How do you solve what are we going to do about Ukraine funding and other fiscal priorities? And all of this is happening at the same time that we're seeing slowdown in the consumer, slower labor market growth. You're seeing issues with the debt costs as we continue to see higher debt servicing costs because of higher interest rates. And that's putting even more pressure on the budget as well. And I think investors in particular are really starting to just look at what is going on in Washington and starting to be a little bit uncomfortable about whether or not policymakers are actually going to be able to handle these issues as they come due. And that's something that is going to continue to put pressure, I think, especially on bond yields.
And Jeanette, so lots of moving parts here. If this does perhaps increase the risk of a government shutdown, do you think that also increases the risk of a Moody's downgrade?
Right. So we have been concerned that if we had seen a government shutdown in the current month, that Moody's may potentially put the U.S. on a credit ratings watch. The Monday before we were potentially going into a shutdown, so last Monday, Moody's actually did say that they may intentionally do so because of a government shutdown, because the credit rating agencies have been more focused on process rather than finances. And if this speakership vote, again, takes a long time, if we continue to see a lot of dysfunction, if the House is still not able to move forward any bill in the House to actually pass a budget, or maybe they are, but they can't pass anything that's actually going to be able to go through the Senate, that might put Moody's back into play and have them continue to think about whether or not they should put the U.S. on credit watch. Again, particularly as we're looking at U.S. debt rising, net interest costs continuing to go up. And so that is a concern for us in particular. And the more dysfunction we see, we think that probability increases.
And that seems to be more of a concern of markets as well, not just the Moody's, but the debt servicing costs that you referred to. And in your notes to us, you used a word a potential word to apply to the U.S. that I haven't seen in a long time, and that word is austerity. We have not seen either party really enact anything resembling true austerity in a very long time. Is there any actual potential for that?
Yeah, so we have been looking historically at what happens when you have rising net interest costs. And, we have been in this period of fiscal stimulus for about 25 years now, where you could raise spending, you could cut taxes, and you weren't really seeing a big impact on U.S. debt servicing costs. That is all changing now after the inflation that we've had and the Fed's having to raise interest rates and now hold them there. So what we are now seeing is that we have net interest costs at above 14% of tax revenues. Historically, we have seen that that has been the threshold, that once you reach above that level, that is where the US starts to move from a period of stimulus to a period of austerity. And so that is what we are looking to see. We don't think it's going to flip on immediately, but that is something that is now moving forward. The one thing that complicates this a little bit is the 2024 election. So policymakers tend to not want to impose fiscal austerity ahead of an election because people want to get reelected. But the issues are coming due. And so this is something that policymakers are going to have to take into consideration. They may not move before the 2024 election, but the other big issue is that when we get into 2025, we potentially have a new president, potentially have Biden still at the helm. There are all of the individual tax cuts that were passed as part of the Tax Cuts and Jobs Act. Those all expire at the end of 2025 too. So there'll also be another fiscal cliff coming that kind of adds into all of these dynamics.
Jeanette, thank you for joining us today. That was great. We appreciate it. That was Jeanette Lowe from Strategas.
Thank you.
And shares of Apple trading higher today. A couple headlines here to watch. The company releasing an iOS update to fix the overheating issue on the iPhone 15 models, and Apple receiving a downgrade from KeyBank on iPhone sales concerns. So on the software issue, obviously you're an investor, you prefer to hear the software issue. There was some worry maybe it was a hardware issue. That would have been a much bigger deal. The downgrade is interesting. That is a rare thing, Julie, we see from the street, a downgrade of Apple. But it sounds like bottom line, the analyst saying valuation, he argues, not attractive. U.S. sales, he says, likely to struggle. Of course, U.S. big market for Cook's company. And competition from local rivals like Huawei in China, he sees as a challenge. I don't know if I buy that last argument, only because often people that come into the Apple ecosystem, they tend to be pretty satisfied and loyal. It's sticky. They don't tend to leave. But regardless, it is a rare thing to see a downgrade like this. But again, Apple shares actually edging higher in today's trade.
Yeah, so it doesn't seem to be affecting it from that perspective. Just looking at the analyst coverage of the stock. So this is a downgrade, we should make clear, to sector perform, the equivalent of or sector weight, I should say, according to their ratings, which is the equivalent of a hold rating.
A meh.
So a meh.
Yeah.
I like the meh rating here. So there are 14 holds on the stock, 34 buys, 4 sells actually on Apple here. And it's interesting that he's also talking about the estimates appearing what he says are full from a top and bottom line basis here. That is, people are, if they're not over optimistic, they're, just about in line with reality here, which doesn't necessarily imply a lot more upside for the stock. But we'll see what comes around the next time they report. Speaking of reports, let's talk about Tilray. That stock is trading lower, but it's pared its earlier losses. Right now, just down about 0.25% after reporting first quarter results this morning. Tilray reported a 15% increase in net revenue to about $177 million. Also saying its net loss narrowed to $56 million, but that loss was still wider than analysts estimated, which is one of the things that have been pressuring the stock here. So Tilray, an interesting story here. The company also just recently closed on the acquisition of 8 beverage brands from Anheuser-Busch, including some beer, but also an energy drink, Highball. I don't know if you know that one. It's diversified into craft brewing. That's something that it's been doing over a little bit of time.
But my big question for you. So I get it. Revenue popped 15%.
Yes.
The loss narrowed, not as much as what the street wanted. My big question, cucumbers. What is going on with the cucumbers talk?
So I was reading through the conference call, and they kept talking about vegetables and then mentioned cucumbers.
Right.
So it seems that in some of their facilities in Canada, which is where they grow their cannabis, that the utilization is not necessarily 100% at all the factories. So in those factories, and it's unclear to me if they're growing or leasing out the space, but cucumbers is indeed one of the crops that they are growing.
I think you got to get a Yahoo Finance camera to the cucumber farm. That's good stuff. Right. All right, and another stock we're watching, we're going to round it out here with, of course, Disney. Shares trading off, it's about 0.5% there. The company offering limited time discounts on children's tickets to Disneyland and Disney World as it tries to boost attendance. Starting October 24th, Julie, you can buy tickets for kids ages 3 to 9, starting at $50 a day. These tickets can be used between January 8th and March 10th of next year. Of course, there was talk over the summer about theme park operators. It wasn't just Disney having some U.S. attendance issues. And I remember the talk from the companies was, well, it was these summer heat waves. Some analysts, though, were saying, well, it could also be the prices.
I mean, the company did see a 13% increase in its parks revenue last quarter. It has been a strong area for them. So that's why it was so interesting to hear these reports that attendance might be seeing a little bit of an issue. So it's interesting. Investors don't seem to be paying that much attention to it today, with the stock only off 0.5%. So it's not necessarily being seen as a serious signal that demand is weakening and they're trying desperately to get more people in. But it is an interesting thing to continue to watch. Have you taken your daughter yet to any of the
Disney
Disneys?
World? No, I live in constant fear that my 4-year-old will ask to go to Disney World. But I don't think I'm going to have a choice because my entire home is now blanketed in Frozen.
Oh, yes.
Frozen
you're gonna
blankets.
have to go. Yes.
Frozen dresses.
Yes.
Frozen toothbrushes.
So I have one word advice for when you do end up going to one of the Disneys.
What is it? I need it.
That word is surrender.
Yeah, right.
Just give in.
It sounds exhausting, but I don't think I have a choice. It's coming.
Yeah.
Whether I want it or not.
You'll just surrender and you'll be fine. All right, we're just getting started here on Yahoo Finance Live. Coming up, bond yields are pulling back today on weaker than expected jobs data ahead of Friday's government jobs report. How could all of this affect the Fed's soft landing scenario? We will get some views on that. And Starbucks is closing 7 of its stores in San Francisco by the end of the month. We're going to dig into the reasons behind those closures. Plus, Constellation Brands is reporting earnings on Thursday. Find out how the company is benefiting from the Bud Light boycott and why one analyst says the stock is a best idea. We've got all that and much more when Yahoo Finance returns. The summer of strikes extending into the fall here. The latest Kaiser Permanente workers hitting the picket line in several states today. This one is planned to be temporary, but the demands echo what we've heard from UPS workers, writers and actors, and auto workers. A lot of it goes back to higher pay. And while there have been concerns about wage inflation as a result, a new analysis shows that might not be the case. Joining us now, David Miracle, Goldman Sachs chief U.S. economist. David, thank you so much for being here. Really interesting research here, because we here have been discussing a lot what all of this union activity ultimately will yield for U.S. workers. Talk to us about how their wage increases compare to non-unionized workers, for example.
Sure. Look, in 2022, we had a high inflation problem, and at least part of that problem came from wage growth running at a rate that's not compatible with 2% inflation. We got there in part because we had a very tight labor market, and we experienced a number of inflationary shocks that drove up headline inflation, enough that this was not lost on workers. They knew their cost of living was going up sharply, and reasonably enough, they wanted some compensation for that. That translated into a rate of wage growth that we estimate peaked at around 6% year on year. That's a ways above what we think would be compatible with 2% inflation. We think something more like 3.5 is compatible with the Fed's inflation target. The important point, though, is what we're seeing with unions right now, I think, is more the final echo of that inflation and wage surge last year. What's different about union members, it's tempting to think that what's different about them is they have more bargaining power. So they're sort of the vanguard of these demands for bigger wage increases. But actually, I think what's different about them is simpler. It's that many of them, have multi-year contracts. On average, their contracts last about 3 years. So all of those big wage increases that other workers were able to ask for last year, many unionized workers just have not had an opportunity yet to say to their employers, inflation rose a lot. I need a cost of living adjustment to keep up with that. So I think basically what we're seeing is kind of the last leg of that wage surge in response to high inflation and a tight labor market. But of course, both of those pressures have diminished substantially. The labor market is much less tight than it was at the beginning of 2022. And headline inflation and near-term inflation expectations are much lower. So I think it's fairly clear that the things that drove high wage growth are on the way out, not on the way up. It takes a while for wage growth and inflation to come back down because not every price or every wage contract changes the very next month. And I think that's basically all we're seeing with the union wage increases.
And did also, so there was this idea that, okay, unions, they're going to a negotiating table, they're securing higher wages for themselves, that could stoke inflation. But is another point here that there aren't enough unionized workers in the country to really make that big of a difference? I mean, I think it's like 10% of overall workers. Is just the sheer numbers also an issue here?
That's right, too. You think about the direct impact of union workers on aggregate wage growth, and it's fairly modest, in part because they're only about 10% of the overall workforce, and in part because sometimes the reality is a little bit different from what you read in these newspaper headlines. Maybe you read, for example, that some group of workers' wages rose by 30%, but then you read, actually, that was over 5 years. That would imply a 6% roughly annualized pace. Certainly not, you don't want to conflate that with a 30% annualized pace. That would really be a big deal. On average, we find that in the recently agreed to union wage negotiations, the typical pace of wage growth is around 6%. Now, that's about 1.5 points above the overall rate of wage growth. So if you take that extra 1.5 points and multiply it by 1/10 of the labor force, that's worth about 15 basis points on overall wage growth. It does boost it. That's right to think that this pushes up the overall amount, but not by very much.
So when all is said and done, and maybe this is a bridge too far, David, is it better for a worker, more beneficial from an economic perspective, for that person to be in a union or not to be in a union?
I think that's a different question from the question about cyclical wage pressures. There is a lot of economic research that's showing that unionized workers do, over the course of time, manage to negotiate higher wages than they would outside of unions. But right now, in the context of the current macroeconomic debate about where are we in the inflation fight, it's not really an argument about kind of in the long term, where might wage levels go, what share of a company's revenues might they be able to claim. It's more about, are these big wage increases a leading or a lagging signal for overall wage growth and therefore for inflation? And I think it's pretty clear that they're a lagging signal.
David, thanks so much for that insight. That was really helpful. That was David Miracle from Goldman.
Thank you.
Oil prices falling sharply in today's session, and it comes after prices hit their highest level this year in September. OPEC Plus reaffirming its current output reduction strategy, while JP Morgan says demand destruction has begun in the oil market. So how can investors play the moves in crude? Here to discuss, we have Neil Dingman, Truist Managing Director for Energy Research. So Neil, let me start with this. It was not that long ago, Neil. By not long ago, I mean last week, that we were talking to investors and money managers, economists, saying, okay, oil is going to go to $100, then beyond. Now, of course, we've seen some reversal there. On the demand side, Neil, I'm interested to get your take to this JP Morgan note. They see demand destruction. They think consumers are going to top off their tanks and they're getting nervous, and that's going to dampen demand. Is that how you see it?
I think there's a little bit, nice, by the way, Josh. I think you're right. You see a little bit of demand destruction, and it is evident that demand is the primary driver over supply, because you've had, on the supply side, you've had Saudi step up today, say, we are going to continue with the voluntary cut. You've had Russia step up. My U.S. companies continue to say they have incremental new supply, but obviously demand is the largest driver. Is it demand destruction? Well, I mean, you did see gasoline right now at, more than 20, at a seasonal low that we haven't seen in more than 20 years on the gasoline side. So I guess I'm a little bit surprised. I continue to be surprised. It's the efficiencies of the operators, efficiencies of the refineries, how much production we continue to get, even though you're basically not adding activity, if you will. So you're right. I think the long-winded answer is we are seeing some demand destruction. I don't think we're going to get much more from here, and I do think we go back up, maybe not materially higher, but I do think we go back higher.
And so, how much are we going to get to $100 a barrel? Does it really, is the difference between 85 and 100 material here? Even, Neil, how should we be sort of framing the oil question in our minds right now?
For Julie, I think for the energy companies, if I look at my E&P companies, to me, anything above $70, they're making a good return. Above 90, they're making a great return. And what's unique now is the shareholder return that the average E&P basically throws off is more than any other sector out there. So yes, I think there is chance that we could see 100 at least temporary. The old adage, what's the cure for high prices? That's high prices. So, I'm one that I don't think we go to and stay at 100 very long. Do I think we can stay above where we are now, somewhere north of 85 but below 100 and stay there for a while? Absolutely. And remember, given that the all-in break even for some of my better companies is around $40, as I mentioned, I can't emphasize enough, they're making a ton of free cash flow that they're willing to pay out anything above $40, and certainly as it gets above 70 and 80, they're making a ton of free cash flow.
And Neil, the expectation is that also the Fed might be done raising rates. How does that impact your sector?
Not as much as you would think. The energy sector continues to be one of the absolute best self-funding. So when it comes to, you go back 3 or 4 years and my company's had 2 times, 3 times leverage. My average company right now has less than 1 times leverage. So, it used to matter, obviously, what happened to rates, because the revolvers would keep going up, the cost of capital would go up. Fortunately for now, their cost of capital is really more internally versus what they're going to have to go borrow, because most of them don't have to go borrow anything. They're deciding, Josh, of our free cash flow, are we going to pay out 50%, 60%, 70%, because they only need, in many instances, they only need 30, 40% to reinvest in the business. So the question becomes, what do I do with all this excess free cash flow? It's a nice question that they have. But again, I always think it's kind of illogical when prices go up. There's certain weeks that some of the energy names in the energy sector gets hit the hardest. And because they're so self-funding, I just don't think that makes any sense.
Neil, give us some ideas here for investors. Given that you think oil's going to be between 85 and 100 here for a little while, do you just buy the whole sector and forget it? Or are there some that are even better poised than the rest?
I think that's a great question. I think there's some, if I thought oil was going to go to 100, maybe even stay higher, then I would say I'd probably go with more of the beta plays. But when I think if oil is going to stay, let's call it that band that you mentioned, 85 to 100, one, I look for the best investors, one that's not going to get me in any trouble operationally. Number two, those same best operators have some of the lowest cost. I mentioned 35, in some cases well below even $35 break even. So three that I like, I mean, one on the very large cap side, that's ConocoPhillips. Conoco continues just to accelerate not only the Permian, international, the list goes on of their areas. Number two, a little bit smaller, that's Diamondback. You look at what Diamondback Computer, Permian company, one of the best operators, continues to be one of the best operators out there, pays a great dividend and has a lot of buybacks. And then number three, a little bit newer company that's been around only publicly about a year, but the name is Permian Resources. The stock has actually done quite well this year. Some young guys that run it, again, another pure Permian company, but I just think they're going to have exceptional growth and they're going to have shareholder return that's going to follow that. So again, I just think those three are ideal given they're fantastic operators with very low break evens.
Neil Dingman, thanks so much, and some actionable ideas for investors as well. Appreciate it. Good to see you.
Thank you.
The ADP report coming in weaker than expected for September, raising some concerns about the strength of the labor market heading into Friday's jobs report. Jared Blickery here with a look at why, good or bad, however the data comes in on Friday, could be bad for stocks. Jared, please explain.
Okay, Julie, you might recall yesterday I was at the New York Stock Exchange with Alfonso Pecotillo, the proprietor of the Macro Compass, and he was outlining his argument for why markets are about to crack. They have not yet, but because of the Fed's tightening and because we are at the stage of the economic cycle when growth is slowing down, this could cause problems. It could cause a major disturbance in the market like we saw in late 2018 or even in the global financial crisis, which would have been much worse. Now, we don't know how this is going to evolve yet, but let's go to the Wi-Fi Interactive and map out some scenarios here. I'm going to start with the 10-year. We have yields at 4.73% in the 10-year tenor. This is up markedly just from where they were earlier in the year. This is a year-to-date chart, and you can see there's really been an acceleration over the last few months, and that occurred when we got just above 4% again. That's been an important threshold, and you can see it's been from the lower left to the upper right over the last 3 years. But this tightening that we've seen in here, what is called a bear steepener, that's when Treasury prices are going down, sending rates up, and also making the yield curve less inverted, more steeper than it used to be. This is ripe for causing a credit market dislocation. And as further evidence, let me just show you what's happened to the yield curve over the last few months. Since the end of the second quarter, this is what the yield curve was looking like in the shorter maturities, all the way to the 10-year, all the way to the 30-year. It is shot up, and you will see now it's actually quite a bit less inverted than it was. And we know that typically presages a recession. Now, if the report comes in super hot, guess what? That doesn't say recession. That says maybe the economy can hold higher rates for higher, and when we might see the 10-year north of 10% or 5%, excuse me, with yields north of 5%. And this is what Macro Alf was saying yesterday. This causes big problems for equities. So stocks could end up going down just in anticipation of what that does to the credit markets. Now, on the other hand, if the report on Friday comes in really weak, let's say a negative print, well, that just means that recession might be around the corner. Nobody's priced that in yet, and so that could be a negative omen for stocks. Now, if it comes in Goldilocks, kind of in the middle, I'm going to say we probably just kick the can for a later catalyst. But I will say, Macro Alpha is very adamant, pounding the table, that this is a late-stage credit event, and we are at the precipice of something happen, and we are just awaiting a catalyst.
All right, Jared Blickery, thank you for that insight. And up next, if you're in the San Francisco area, you'll have 7 fewer Starbucks locations to choose from by the end of the month. Find out which stores are closing next. stocks moving higher in today's trade as bond yields pull back on that weaker than expected jobs data. But where do yields head from here, and how should investors think about committing capital in this environment? For answers, we're going to turn now to Jay Hatfield, CEO of Infrastructure Capital Advisors. So Jay, let's start there. In bond yields today, relatively calmer. But what do you think has explained this surge we've seen, Jay? First of all, I mean, is it Fed speak, issuance? Is it this country's fiscal challenges? And importantly, where do you see these yields headed from here?
Thanks, Josh. Well, it's important to really focus on the global bond market because sovereign bonds are relatively interchangeable. So we have a differentiated view that really this global bond sell-off is really from ultra-tight central bank activity. And in particular, the ECB shrank their money supply. So they took $500 billion out of their capital markets in short order in late June and early July. And that's really when the sell-off occurred. So we think that's the key driver. Also, the Fed shrank the monetary base. They took $60 billion out of the capital markets. So we think the key driver is not just U.S. related, but globally. And then also, importantly, though, we see that Europe is really in a major recession as we speak. And so we think that's going to be the key catalyst to get rates to go lower, which is really critical for the stock market to rally.
Well, and I guess, Jay, hey, it's Julie here. I guess the question is, on what timetable will that happen, right? You know, just like we were talking about, oil prices, the best cure for high oil prices is high oil prices. I mean, is something like that at some point start to happen in the rates market as well?
Thanks, Julie. Absolutely. So if we keep rates right here around, call it 5%, then the U.S. housing market is going to stall or even start declining radically, and we will head into a recession. So I don't see it as being sustainable. But the reason I'm not too concerned about it is that if you look at Europe and you look at a GDP nowcast that's produced by a number of entities, they really already have started a major recession. Their GDP is likely to be down 0.9% just for the quarter. So it's 3.6 annualized. That's almost as bad as a Great Recession. So when investors start to appreciate that, when the actual data comes out, we think that bond yields will come down. But to your point, if they stay this high, we'll have a global recession and the U.S. may even get dragged into it.
And Jay, what are your expectations for the Fed? Perhaps signaling one more hike here in November. Is that what you see coming?
Well, they absolutely should not raise rates because this 100 basis points of increase in the 10-year is a huge tightening in of itself. Now, this Fed is fundamentally flawed in that they just focus on their Phillips curve models, and they also don't adjust PCE for the horrendous shelter calculation the BLS puts out that's delayed by about a year and a half. So really, run rate inflation's at 2%. So they absolutely should not raise rates. But they're entirely capable of it because they really haven't demonstrated any confidence through this cycle.
So what's the scenario then if the Fed does raise rates again? I mean, what are the knock-on effects? I assume you think they'll be mostly negative.
Well, right. If the 10-year keeps going higher and higher, I think there will be more expectations of a slowdown. And again, we think one reason that our Fed may not raise rates is they'll start to figure out that Europe is in really just a power decline. For instance, retail sales for the Eurozone announced this morning, so I'm surprised people aren't covering it, we're down 1.2% for August, so that's a 13% annualized decline. But to your point, if they raise short-term rates and then long rates just keep going higher and higher, then that would be bad. We don't see that happening really because of Europe, but that is really what we've seen over the last 2 months. And that's why the market's been so weak, in addition to it being the fall.
And Jay, you point out rightfully, listen, there's challenges in China and Europe. The U.S. economy has proven much more resilient, remarkably resilient. Do you expect that to continue, Jay? Are you in that soft landing camp?
Well, absolutely. And we've been in that camp for almost 2 years now. And the reason really started out that we do have a very resilient housing sector. We have a shortage of homes, the lowest homes ever for sale. And we think that'll continue, although if we get mortgage rates over 8%, that sector may start to fail as well. But the other thing is we have all this infrastructure spending And for the first time, it's truly counter-cyclical because it's based on investment. And it drops in investment is what drives a recession, not consumer spending just falling off a cliff. It's layoffs that come from the investment sector that hurts consumer spending. So we do think we'll be resilient, but if the Fed just ignores everything that's going on, keeps raising rates, the 10-year goes well above 5, then I would think that we would have like a very mild recession. And then Europe might have a recession that's worse than the great financial crisis because they're just in a power decline right now with no positive elements to their economy. Unlike the US where you have AI, great housing sector, very low natural gas prices and electricity prices. They don't have any of that in Europe.
So Jay, put all of it together for us. What do investors do?
Well, we actually, strangely, given the market activity, we remain bullish. So it's important to keep in mind that this is just normally a terrible time for stocks. And it's not random, it's because there's no earnings. So we think that everyone will calm down when we get into earnings season. There's a lot of momentum shorting. There's momentum shorting of Treasury bonds as well. So we think they're way too low and yields have gone too high. So we do think, and that's really what we're seeing today, is where people are starting to anticipate earnings and buying tech stocks. So we remain bullish and are sticking to our 4,500 to 5,000 target for the market, but just be a little bit cautious over the next week before we start real earnings because we think companies are doing well and that markets tend to overshoot during this time frame of the fall.
We will be keeping an eye on that. Indeed. Jay, thanks so much. Good to catch up with you. Infrastructure Capital Advisor, CEO Jay Hatfield. Appreciate it.
Thanks, Julie.
Thanks. Starbucks is closing 7 stores in San Francisco by the end of the month. It's the latest big chain to pull out of the downtown area following Target and Whole Foods, who cited rising homelessness and safety issues. Yahoo Finance's Brooke Palma is here with more. Brooke, I keep trying to figure out, as we keep getting these headlines, how much of this is routine and how much of it is unusual? What can you tell us about Starbucks in particular?
Right. Good afternoon, Julie. Well, certainly here, Starbucks playing this as a simple real estate strategy. They're saying that it's a standard course of business and they continue to evaluate the store portfolio. So those 7 stores in San Francisco will close on October 22nd. And they said that employees were informed on Monday and they'll be given the opportunity to transfer to another location on that date nearby. Now, as you can see here, these store locations are mainly in the downtown San Francisco area that's gotten a lot of buzz recently, especially post-COVID. They include on Mission and Main, Battery Street and Market Street, among others. And it is worth noting that none of these locations are union stores. So these are not stores that voted to unionize. But in a letter from Northern California Regional Vice President to employees, she said that there are several factors Starbucks considers when tasked with the tough decision of closing a store, but it's all part of ensuring a healthy store portfolio. Now, despite these closures, Starbucks will still have a presence in San Francisco. They now have 59 stores in San Francisco, and following these closures on October 22nd, there will be 52 remaining. But when Starbucks asked if this was a decision made due to a threat of safety of both employees and customers, well, Starbucks spokesperson declined to comment on that front. But as you noted, Julie, this is a big story here, considering the fact that just last week, Target closed 3 stores in the San Francisco and Oakland area due to a threat of retail crime and organized retail crime, that is. Also, in addition to that, we saw earlier this year, Whole Foods Market closed on Market Street in San Francisco due to safety concerns. And you see here a slew of others have recently closed, including Amazon Go stores, Anthropologie, Office Depot, Old Navy, as well as Saks off 5th. And this also comes as San Francisco downtown area, they continue to struggle to bring back foot traffic post-COVID, as not many people, office employees, are going back there as we continue to see vacancy rates rise in offices downtown. So certainly lots of factors, but Starbucks saying here is simply a real estate play.
Brooke Palma, thank you. And coming up, Ford continuing to negotiate a new labor contract with United Auto Workers. Find out how the UAW is reacting after the break.
Ford reporting a rise in U.S. quarterly sales, showing substantial increases in trucks, in particular in the third quarter. This coming as the automaker continues to negotiate a new labor contract with the United Auto Workers. Ford putting up a 7th offer to the union workers on strike. Here for what the road ahead looks like for Ford and the auto industry more broadly is David Whiston, Morningstar Research U.S. Autos equity analyst. David, thanks for being here. You know, Ford really seems to be the one that is getting a lot of negative chatter here, and its third quarter sales rose in the single digits, though, by 7.7%. We saw double digits for some of the others. Is Ford sort of the big loser in this whole union negotiation situation?
I think that's a little extreme to say that. They do have some of the most exposure because they have the highest UAW headcount. They also have the highest of their North American production mix. They have the most in the United States at over 80%. But it really just depends what does the ultimate deal look like. You know, things like wage increases get a lot of attention, but they're by far not the only thing that matters here. And honestly, I could live with, as an analyst, I can live with even north of 20% wage increases. It's things like reopening the pension, reopening retiree health care, the jobs bank, things like that, in my opinion, are just not affordable.
The more this strike drags on, though, David, what do you see the risk for production for Ford?
Well, the production risk seems to be all tied to what does the UAW want to strike. They've been doing this for now mostly on assembly plants and then the parts distribution centers, which for GM and Stellantis, which I think is more to unfortunately hurt the dealers and try and get the dealers to put pressure on the automakers to get a deal. Ford hasn't had those centers hit yet. The union, though, in my opinion, they've actually, I mean, what's happened is bad, I want to be clear, but they haven't done things to enact really deep flesh wounds yet because they haven't gone after full-size pickup trucks. They haven't gone after key powertrain centers, parts centers, like GM's Romulus plant, for example. And they haven't gone after full-size SUVs either. So it'll be interesting if there's another announcement this Friday. Will they go after something more, something that will hurt deeper? And Ford would have the most to lose there because they make all their pickup trucks in the United States, to be clear.
Gotcha. So if that happens, then could we see another leg downwards for the stocks? Yeah,
and I'm actually surprised how well the stocks are holding up given the circumstances. Not that they've been doing great either, but I've also noticed nobody is taking the lead and cutting their estimates yet, and I think. Frankly, nobody wants to be first to do that. I think we're all, as analysts, probably just waiting for an update with Q3 earnings because assuming the strike does continue for a long time, the guidance given at Q2 earnings is almost certainly going to be off the table. It's just a matter of how bad does it get.
And David, borrowing costs obviously going up for consumers. How do you think about that dynamic ahead for Ford and the others in terms of a challenge to vehicle demand?
I'm sorry, what costs? I couldn't hear you.
Borrowing costs.
Oh, borrowing costs. Yeah, so interest rates, it's more the magnitude or the delta and the rapid rise of rates that's been so hard for everyone. And frankly, there are many consumers that have been spoiled because since 2008, we've had ultra low rock bottom rates. And that's just, when you look at throughout economic history, it's not always been that way, such as in the early 80s. Rates, though, are not as bad as they were in the early 80s. So generally, a 100 bip increase in interest rates on a new vehicle loan, it's roughly $18 to $20 a month more. So there's still leeway for the Fed to keep raising rates and not have it completely cripple auto demand. Obviously, I'm not wanting the Fed to do that. Hopefully, they'll stop soon. But there's leeway here.
And what about borrowing costs on the parts of the companies as well? You know, General Motors with that new credit line.
Yeah, this morning GM announced they've established a new $6 billion credit line. That's only a 364-day maturity. Ford did something similar back in August at $4 billion. I'm not aware those lines have actually been drawn, but it's obviously, in my opinion, just a lot of liquidity being added to in case the strike gets a lot worse. So the strike right now it's sort of the ultimate game of chicken in terms of who does the UAW strike fund run out first? Does it deplete first, or do the automakers run out of cash? I think the math is on the automakers' side, but to do that, the automakers are going to have to take on a lot more debt. And once they do that, of course, more debt should be bad news for the stock price.
David, thanks for your time today. Appreciate that insight. David Whiston, thank you. And coming up, the closing bell on Wall Street. We're checking in on the latest market moves, the top trending tickers. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
You have the closing bell on Wall Street. Let's do a quick check of the markets as Murphy Oil hits the closing gavel there. We see all 3 major averages in the green on the day. The Nasdaq leading with a gain of 1.4%. The S&P 500 bouncing back to the tune of 0.8%, and the Dow up 0.4%. I want to take a look at the sectors within the S&P 500 on the Wi-Fi Interactive just to dig a little bit more into the action and what was happening on the day. Maybe Murphy Oil not having such a great day. That group, XLE, the energy ETF, down 3.3%. We're going to dig more into that in a moment. Utilities also lower on the day, even with the pullback in bond yields. Where do we see strength? Consumer discretionary bouncing back from yesterday's declines. The XLK, that's infotech, as well as materials and real estate also doing well in the session. So that was what was prompting the gains. Let's talk about some individual movers making big moves on the day as well. Big egg maker, Cal-Maine Foods, those shares sliding as the egg producer provided a weak earnings report. The company's sales in the quarter slumped by about 30%. The shares down 7% on the day here. Average selling prices for shell eggs have returned to more normalized levels, said the CEO Sherman Miller, and the overall egg supply is recovering from avian influenza. You know, we've been watching egg prices so closely. They were really a big headline there and part of CPI for a while. That was good news for Cal-Maine for a little bit, right? I mean, not easy to deal with an avian influenza outbreak, but from a price perspective was positive. And so normalization in their case is not necessarily good for their sales.
Yeah, reported earnings and missed, sales down about 30%. And to your point, the average egg prices apparently down to $1.59 per dozen from $2.28 in the year ago period. Good news for me and my breakfast every morning, not so much for them.
Are you an egg guy every day?
Big egg guy, huge egg guy. Oh, yeah. You just combine it with, your 40 milligrams of Lipitor and you're fine. That's the idea. Isn't that what doctors advise?
No, that's an old way of thinking.
Oh, is it?
I don't think there's such a concern about eggs and cholesterol
I shouldn't be slandering
anymore.
the eggs. I shouldn't be saying
I think
I'll stand down.
Eggs are okay now? I don't know. All right.
Moving on, Lithium Americas splits into two separate publicly traded companies, shares surging as Lithium Americas separates from its Argentine segment. So this one, lithium mining startup, now transforming into two companies, Julie, and I guess spinning off Lithium Americas Argentina as shareholders. So if you want to invest in lithium, critical for EVs, here's your chance.
So Lithium Americas owns the Thacker Pass project, which is in Nevada. And this is something they've been working on for a while because just like we are trying to get all kinds of supply chain things based or reshored here in the U.S., lithium is among them. Obviously, there's a huge demand for lithium because of batteries, particularly for electric cars. So this has been something that has been sort of a speculative play because it's not yet producing lithium at that mine as of yet because it's still under construction, but it's been an interesting story. But you can see the shares falling of Lithium America as that split goes into effect. We've been watching a lot of splits over the past week or so.
It's been a theme.
And many of them have not been doing well.
No.
So it's been an interesting space to watch now, but we're going to continue to watch the lithium one. We also are going to continue to watch energy stocks. Now, I was just talking about what was going on with them in terms of the overall sectors, feeling the pressure in today's trading session. Oil prices pulling back from their 2023 highs last month. Exxon, just one example, down by 4% here. But it has really been an interesting day for many of these. And if you take a look inside the Wi-Fi Interactive again, just to look at the sectors and get some perspective on what's been happening. So the XLE, that's today here for the XLE. But if you take it out to 3 months, and you will see a very different picture where you have seen it as the best performing sector in the S&P 500. And that's because of what we have been seeing with oil prices, right? Here's another look at that 3 months on an individual basis. So there's the heat map of all the big energy names on that 3 month basis. If you look year to date, it is not as clear what's been going on, but really the surge has been coming in the past few months for many of these companies. Here's ExxonMobil, for example. That's the daily chart. If you look at year to date, you can see kind of zigzag, but really coming up from the lows in July and recovering since that time.
Yeah, the decline in oil price is just sending energy stocks lower across the board here. You point out Chevron, Exxon, Occidental Petroleum, take your name. You know, we mentioned J.P. Morgan at the beginning of the show and their take on this. Their year-end target, 86 per barrel. So if you're an investor, you're trying to find the stocks that can work in that universe. You got to maybe pick your spots. We had Neil Dingman from Truist, though, giving us some names.
He did, and Conoco was among them. He said you want the lower cost oil producers that are able to get more margins out of that oil they're taking out of the ground.
Yep. All right. Well, the S&P 500 moving higher today after Tuesday's steep losses as Treasury yields pulled back from multi-year highs. Is coming after a tough month in September for the stock market. So what may be the catalyst that can turn it all around? Here to discuss is Adam Phillips, Portfolio Strategy Managing Director for EP Wealth Advisors. So Adam, let's start with yields right here. Relatively calmer day. Do yields really need to stabilize, Adam, before this stock market can move higher?
Hi, Josh. Hi, Julie. Good to be with you. Yeah, I really think that they do. I mean, we're watching yields very, very closely. We saw that bond investors and stock investors today got a little bit of a reprieve, but I think that we need to see a little bit more from here. I think it's not just about yields stabilizing, but really, seeing some downward move in longer-term yields. I think that would be a welcome development to equity investors. I don't necessarily know when that's going to happen, but it's something that we're looking for. I think, the reality is that with yields at these levels, that just adds to this restrictive environment and this tight, tight financial conditions, and I think it's really doing a lot of the Fed's job for them. And so if you think about the upcoming Fed meetings, maybe they don't need to hike again because the yield curve is doing it for them. But at the same time, it's going to put a lot of pressure on equities.
What are the other catalysts, positive catalysts, that could materialize, Adam, that could help stocks out of this malaise? I mean, yes, today's gains notwithstanding. I mean, when earnings season rolls around, is that going to be positive for stocks? And will it help investors sort of overlook bond yields, even if they haven't come down?
I think it could. I think we're kind of struggling to identify that catalyst. That's one of the reasons that we still have an underweight allocation to equities as a whole across our strategies. But as we're trying to think about what these themes might be to drive that next leg higher in stocks, what could provide this stabilization or support with earnings season really starting next week, I think that's one possibility. Right now the expectations are for pretty much flat earnings growth on a year-over-year basis. We've seen more negative pre-announcements than usual. So maybe companies have some visibility. They're trying to get some of the bad news out of the way to set expectations. But going into earnings season, I don't necessarily think it's about what happened in the third quarter. We don't want to necessarily look too much in the rearview mirror. It's about what these companies tell us about the future. How are they dealing with these rising costs, be it wages, or interest expenses, and what kind of data are they seeing when it comes to the health of the consumer, which has really helped to power the economy so far this year. We've seen some cracks start to emerge, and are they seeing the same? And do they expect that to hurt earnings going forward?
And Adam, let's talk about where you do see opportunity for equity investors in the sectors. One is energy, I think, Adam, you're a fan of. We were just obviously talking about that some of those energy names took it on the chin in today's trade. What do you like about the energy sector looking ahead?
Yeah, sure. And you're right. Energy did have a tough day today, thanks to oil prices falling a little more than 5%. But this is a sector that we've been overweight for the last couple of years, actually, and we still think that it's the place to be. This is a sector that has been unloved for so long. Obviously, last year it outperformed by quite a wide margin. This year, not so much. We've seen it start to take leadership again here over the last couple of months. And we expect that to continue. Right now, our focus is on quality, whether you're looking at the energy sector or equities or just equities and bonds. And broad asset allocation. So for equities, we really like the idea that there's a lot of free cash flow generation. And we're also looking at it from the standpoint of we're looking at the earnings contribution relative to the sector's weight within the S&P 500. So an example is the S&P, energy still accounts for about 4.7%, give or take, of the S&P 500, but it contributes about double that or nearly double that amount to the earnings for the overall S&P 500. And so we think there's some room for this sector to run going forward.
And then there's one more sector you like that stood out to me, and that is industrials right now. We're sort of in a tricky moment when it comes to economic growth and forecasting economic growth, although I guess you could argue that we've been there for a little while now. So why do you think a cyclical group like industrials could potentially do well?
Yeah, it's a good question, and it's funny. I feel like we have been in this tricky environment for quite some time, but I think the potential catalyst for industrial stocks, it's infrastructure spending. It's also, depending on where you look, if you look, at the different subsectors within the industrial sector, an area to like is also the defensive plays, right? I think that even though there's so much focus on our spending and government spending, I think that in this geopolitical environment, that's going to be really tough to pull back from defense spending going forward. And so those are areas that, some of those names have been beaten up, and it could offer some opportunity going forward.
And Adam, I want to end here on what you don't like. I think you're underweight utilities here, Adam. Is that just because you think, listen, go-to yield plays are going to have a tougher time competing against a 10-year sitting above 4.7% a year?
That's exactly right, Josh. Yeah, so I'd say with utilities and staples both, I mean, these are historically your yield plays. They are defensive plays, and I mentioned we're focused on quality and defense here, but I think it's just a really hard sell right now when you can get a pretty attractive yield on the shorter end of the curve here. That's going to provide some competition. We talk all the time about how that TINA trade is, there is no alternative. That is long gone by now, and so I think the areas of the market that hurt the most are those that have historically benefited from offering a higher yield, and that's really utilities and staples. The other one that we've been avoiding for quite some time, and actually we've been a little bit light on financials, and we sold our regional bank exposure about a year ago, and so that's an area that we still, for all the pain that sector has endured, we're just not ready to add exposure there just yet. We think that their earnings are going to be under pressure here for quite some time. And obviously the regulatory issues that they're facing are going to make for an uphill climb.
Adam, thanks a lot for all these ideas. Appreciate it. And things to avoid. Adam Phillips, appreciate your time.
Thank you.
Well, Google unveiling new smartphones and a watch at an event in New York City today. The tech giant flexing its muscles with the new products just weeks after Apple launched the iPhone 15 and Series 9 watch. Yahoo Finance's Dan Halley is here with the details on the new devices and whether they can gain some more traction for Google.
Yeah, Julie, that's a good question, because these aren't exactly, market leaders as far as market share goes, but they are really impressive devices. You say it every time Google comes out with a Pixel, it's all about the software, and that's what they're doing here as well. Just give you some rundown. There's the $699 Pixel 8 and the $999 Pixel 8 Pro. The difference between the Pixel 8 and the 8 Pro basically comes down to the difference between the iPhone Pro and the iPhone 15. Though they both have the same processors, unlike Apple's 15 and 15 Pro. The Pro on the Pixel gets a better camera, gets a better display, and it also offers a thermometer on the back that they're working to get FDA clearance for, so you may be able to measure your body temperature with it. Right now, you can use it to measure the temperature of the asphalt if you want to make sure your dog's not putting its tootsies out on some hot concrete, or you can measure how hot your coffee is before you want to drink it. Not something that I necessarily thought that I would want, still don't really want, but if it can work by measuring temperature, maybe I can fake a sick day. The main things that I think come into play here are the AI capabilities and the camera. They upgraded the camera. The cameras on the Pixel line have been great because of the software. They had a night mode that was blowing away everyone else until they finally caught up. And so what they're doing here is just adding more AI capabilities as far as your ability to edit photos and enhance them. In fact, they're going to have a feature coming called, I'm not lying about this, Zoom Enhance. So if you remember, from any sci-fi show, it was always zoom in, enhance. Literally what this is going to do is where you will zoom in, the image will look pixelated, and then enhance it so that it actually looks clear. Sounds awesome. There's also the ability to magic edit, which is a feature where you could say, one example they showed was a boy who was standing shooting at a basket, about 5 years old. You want to make him look like he's slam dunking. You can move him up into the photo, look like he's dunking, and then move his shadow as well, and it'll fill in the back. So they're doing a ton of AI stuff, and that's really what they're going for with this, is generative AI and AI in general. And Dan, what do these new products mean for AI in consumer tech? Yeah, I mean, look, this is, they're pointing that this is the first generative AI phone. It's running their foundational models on the phone itself, which is, unheard of. And so, you can imagine that this is only the tip of the iceberg when it comes to what we're going to see moving forward. But, for Google, they have been about AI on their devices. They were never about really, trying to outmaneuver the likes of Samsung or Apple as far as hardware goes. They're getting there, though, now, especially with that $9.99 price tag. But it's always been about AI, and they're just, doubling, tripling, quadrupling down on it right now.
Dan Howley, thank you, sir. Appreciate it. And coming up, Constellation Brands reports second quarter earnings tomorrow. We're going to break down the possible investment opportunity after the break. Constellation Brands set to report earnings on Thursday. It has traded up around 9% year to date. Our next guest expects it to continue to go higher. Gerald Pasquarelli is an analyst at Wedbush. They just raised their price target for the brand and added it to their best ideas list. So Gerald, fan of the stock, clearly, in terms of catalysts. We've got that earnings report. As a bull, I'm guessing you're expecting to hear good things tomorrow.
We are. Thank you for having me. Constellation has been one of those companies that kind of struggled earlier in the year. There was some poor weather that resulted in a slowdown in some of their core brands. And what we've really seen over the course of their fiscal second quarter was a reacceleration in trend. And we think that that's going to result in better depletion growth. We think that there's a potential for a guidance raise. And so, we're thinking that this quarter is going to act as maybe the most near-term catalyst to really get this stock to start to work again.
Gerald, are the gains that we're seeing for Constellation, is it coming from volume? Is it coming from price? And what kind of differential are we seeing amongst the different products? Wine, for example, had not necessarily been as strong.
Sure. So good question. Constellation is historically a volume-driven revenue growth story, and that's largely what we're seeing now. One of the other reasons that I mentioned when their beer trends had been decelerating was the fact that the retailers took too much pricing at the start of the year. And so their price gaps kind of broke down where there was too much pricing at the retail level. That's come more in line. And so what you've seen is an acceleration in volumes in tandem with moderating price mix. When you look at what our estimate for beer for the quarter is, we're at about 9.7%, call it 10%. We're expecting 7.5 points of volume growth and the remainder of that to be pricing. So definitely volume led. Wine as a category has been under pressure, and Constellation is kind of in the midst of cycling a divestiture in the year ago period. And so right now, their reported revenue results are going to be impactful to the they're going to be negatively impacted. They're going to negatively impact reported revenue growth from a total company perspective. So not really expecting much on wine, but this is the stock that very much trades on beer.
And Gerald, how much has Constellation been able to kind of benefit from the challenges with Bud Light? I mean, obviously Bud Light got caught up in this culture war. Has Constellation been able to capitalize on that dust-up?
I'm sure to an extent they're capitalizing. I mean, Modelo became the #1 beer brand in the United States. They were going to become the #1 beer brand. It was just a matter of time. I guess the Bud Light marketing controversy accelerated their reign to the #1 beer in America. But when you look at the share shifts out of Bud Light, this is largely a Molson Coors phenomenon. The share shift out of Bud Light is really going to Miller Lite and it's going to Coors Light. So you could argue that just given the sheer size of Bud Light, the category is benefiting, but the main beneficiary here is certainly Molson Coors.
And Gerald, sort of a bigger question here for you on the demand for alcohol. You know, we have seen, at least anecdotally, a rising non-alcoholic kind of movement, if you will, and demand for non-alcoholic beverages. Is that something you're seeing in your research, and what kind of risk does that put the likes of Constellation and its competitors under?
I think there's a trend I think that non-alc fits with the health and wellness trend that we've seen for about a decade now, whether it's low sugar, low carbs. Younger consumers, for whatever reason, are not drinking as much as older consumers. And so you've seen companies tap into that by offering non-alcoholic options on, in Constellation's case, Corona. You've seen competitors do it. And so non-alcoholic beer is a very small base. To the extent the consumer continues to gravitate towards non-alcoholic beer, I think that you'll just see more non-alcoholic offerings on high quality brands, just be part of their innovation cycle over the years to come.
And Gerald, last question here. You're bullish on this name, but what are the risks, Gerald, to your thesis? What are the risks you think about and that investors should have on their radar?
Sure. Modelo could presumably start to slow. It does not look like there are signs of that, but Constellation is very much a beer-focused company, right? So if their Modelo brand slows, that's going to result in decelerating sales. That's likely problematic for the stock, especially as they're going to be cycling up against very easy compares. The other thing is if commodities continue to, if commodities, which are expected to ease, if they show a reversal in trend and remain high or start to increase, you may have another dynamic where the company is going to miss its long-term target on 39 to 40% beer margins longer than expected, which would likely not be well received by the street. So that's really it. But again, we monitor these kind of dynamics. We're not really seeing it. We think the company is set up for brighter days ahead.
Gerald, thanks so much. Cheers. Gerald Pasquarelli, analyst at Wedbush. Appreciate it. Well, the business of cannabis. Tilray releasing its first quarter earnings today. The company saw a 15% increase in net revenue to $177 million. I talked to Irwin Simon, Tilray Chairman and Chief Executive Officer, earlier today about the company's latest quarter. We also talked about the acquisition of 8 beer and beverage brands from Anheuser-Busch, and we talked about marijuana regulation.
You got to grow the top line to drive it to the bottom line. And I think what's important is, we're seeing growth in all our segments, basically. We're well diversified within cannabis and within our beer, within our spirits business, our medical cannabis business. If you come back and look at our financials and look at our loss, of the $55 million loss, almost 40 million of that's coming from amortization, stock compensation, some litigation costs and transaction costs. So I look at free cash flow and driving cash, and we plan, this year to be, cash flow positive. But Julie, step back for a second. It took Tesla almost 20 years to be profitable. It took Amazon, almost, 9 years to be profitable. With Freya, Tilray, Hexo, and our beer businesses, I started this in 2019. We're on a run rate to be $1 billion in sales. So ultimately, yes, getting to cash flow, positive is important for us. But I think that's what, our investors need to understand. There's a lot of non-cash in there that ultimately, is part of the net loss.
Well, speaking of growing the top line, you guys just closed on the purchase of 8 beverage brands from Anheuser-Busch. That happened right before you guys reported earnings. And we talked a little bit last time about the integration and hopefully improvement in sales of some of those brands. Can you just talk to me very quickly about that process and what investors can expect there?
So we closed on that on, Friday afternoon before we thought the government would shut down because we had to get all these licenses transferred. Monday morning, we hit the ground running. Matter of fact, after earnings today, myself and Ty and the team are on the road starting to visit, some of these breweries out there and start integrating the procurement, the production, the sales, the marketing aspect of it all. These were 8 brands with, a lot of good brand equity, a lot of notoriety. They've been around a long time that ultimately ABI bought them. And I think they were just brands that might have got lost within the big ABI system. And with that, we're fortunate enough to buy them. And hopefully with a lot of good marketing, a lot of good sales, a lot of good changes in there that we start to see growth in these brands. Because, it's important, I tell our investors, these brands today aren't growing, but what I come back and say, what's gone down ultimately has an opportunity to go up.
Right. And the craft brewing business in the U.S., at least, volume-wise, has fared a little bit better than the mass beer business. On the M&A front, obviously, you've been very acquisitive, including that deal. Reading between some of the lines on the conference call, it sounds like maybe you're kind of stable where you are. You're happy with the mix where it is. Does that mean that you're not going to be as acquisitive?
Listen, this year, we acquired the Hexo business, we acquired these ABI brands, and we acquired from Molson's Trust, which is infused drinks within, the Canadian market. So we've done a lot. Stepping back and looking at our business today, our Canadian business, is growing nicely. It was up, 15% within our Canadian business, or it's actually 16% from a cannabis standpoint. We sold 20 million pre-rolls, within the quarter. We expect to sell 80 million, next year. So there's still a lot of integration going on with the Hexo business there. There'll be a lot of integration going on with Trust. In regards to the U.S., between the 8 businesses that we just acquired, along with Montauk and Sweetwater, there's a lot of integration that has to go on there. And last but not least, our Breckenridge distillery business, our bourbon, vodka, gin business, there's a lot of growth there. And Europe, we sell in 21 different countries today, medical cannabis. And we see, continuously growth in opportunities with medical cannabis. So we see good growth opportunities. We see some acquisition opportunities there. And then we have a business called CC Pharma, which is a medical distribution business that we're rebranding Tilray Pharma. In that business, we'll look to distribute medical cannabis. So we got a lot on our plate. We got a lot of integration to do. And what I'm looking at this year, in regards to, hitting our numbers is top line growth. We have built into our plan to get a lot of synergies. And that's going to come, from putting these businesses together, taking out costs. And ultimately, that's how we get to free cash flow positive.
Erwin, I want to turn to regulation because the last time we talked about the dim prospects in the U.S. of federal marijuana legalization, but there are other things going on. There's talk of reclassifying marijuana. There's also, of course, that bill under consideration that would affect banking surrounding marijuana. Since you guys don't sell marijuana itself in the United States, would any of this affect your business?
Not really. And Julie, I've been very clear about it. Declassification does not help us. But where it helps everybody, it gets a lot of confusion out there in regards to cannabis. Listen, cannabis today is in the same classification as heroin, LSD. Actually, it's in a higher classification than cocaine today. So we need to get out there. You know, a lot of consumers today are just confused. And I think that's what happens there. Ultimately, where does this help us? If medical cannabis legalized, we bring our expertise from our Canadian medical cannabis and our European cannabis business. And if we can sell in the US, we would do that. One day, hopefully, and you know, this is hopefully, that we could sell cannabis from our Canadian, you know, facilities and sell it into the US. But if it happened tomorrow, it directly does not benefit Tilray at all.
Gotcha. And what about on the banking front? I assume that one also.
Well, same thing today, because we don't sell, you know, we're listed on Nasdaq, we're listed on the Toronto Stock Exchange. We cannot touch, the plant or the flower in the US. So ultimately, it would not affect us if safe banking came into play. But the big thing is, ultimately, you know, with some sort of legalization and federal legalization, Tilray can become a bigger player or a player within the U.S. cannabis market. And that's what I'm hoping for. And ultimately, listen, Julie, with our beverage business, our beer business, you know, our food business with Manitoba Harvest, they are adjacencies to the cannabis world. And with that, that would allow us to jump into the cannabis business within the U.S., which is a big, big business. You know, we have the experience, we have the know-how, we have the facilities, we'll have the distribution, we'll have the brands.
That was Tilray CEO Irwin Simon talking about the latest quarter and much more. Coming up, we're going to go around the horn with some of today's top trending stories, including viewership numbers for ABC's The Golden Bachelor. That's next.
Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Madison Mills. We are breaking down some of our favorite trending stories of the day, guys, and it is Jobs Week, Labor Week, lots of labor data out. It's one of my favorite weeks. It's exciting.
You love labor data?
Yes,
He loves it.
And Labor Day because we don't have to work. But there was a fun chart today. All right, this chart, you guys are going to like this chart. It's interesting. So we had the ADP report out today, and what we're looking at here is annual wage growth. In that top purple line, you're seeing people that changed jobs. On the bottom blue line, you're seeing people that stayed in their job. You can see over the pandemic in 2022, we saw that big increase for what we were calling those job hoppers, right? People were leaving jobs. Some people were staying at jobs for only 6 months because they're seeing a near 16% increase in their pay when they were leaving. That was down to 9% in September. And you see what you see happening there is that margin in between job changers and job stayers coming a lot closer together, which might be a sign that the labor market is cooling and we're not going to see as many people leaving their jobs. Maddie, my overall takeaway just looking at it was maybe we're finally done talking about job hopping, right? I feel like that was the talk of 2022 was you had people that were staying at jobs. It seemed like, based on some anecdotal stories, 4 or 5 months, and then they're just popping to a new job.
Well, and the great resignation narrative feels like it can finally be put to bed. We also got in the JOLTS data, just to hop back another day, information about quits and layoffs being relatively unchanged. So I'm really curious, to your point, about Friday's jobs data and what we're going to see in terms of whether or not those layoffs versus hiring numbers are continuing to be sort of a leading indicator for the Fed heading into that November meeting.
Yeah, we were just talking in the break. What does this all mean for the Fed? And I think it means different things when you think about the future of rate hikes, of monetary policy. I think the Fed has its work cut out for it in the next November meeting, whether or not they're going to choose to raise those interest rates. But certainly the wage growth is slowing down that significantly. It's crazy that in 2022 you could get a very sizable increase.
And think about what was happening in 2022. Inflation was rampant, right? Because when you have wages that high, people have the ability to pay up for things. And so that's why the Fed has been so concerned about wages and why we're going to take a look at wages again on Friday. When you have wages continuously high, the consumer is going to keep spending. That resilient consumer we keep talking about. You want those wages to come down, eventually pace with inflation at 2%. So then everything is a little bit normal. So we're starting to see things come into a quote unquote better balance, as Mr. Powell likes to say.
The industries too are interesting too, because you think about the tech industry, they went through a lot of layoffs, right? Because there was an overhiring during the pandemic. Then we saw a bit of that correction. So it varies by industry as well. It's just the labor market's a very interesting story right now. It's a very interesting place.
And it's always interesting, right?
Working's fun.
Yeah, we're doing right now. We like to work. We love our jobs.
Exactly. Well, sticking with tech, as you mentioned, great news from Uber today, which I'm personally going to be severely impacted by. They're offering $5 to return your packages for you. So this is any returns you might need to do. I can already see Josh rolling his eyes at me, but this is a flat $5 fee, to return a package, available in nearly 5,000 cities. I talked to a spokesperson today who confirmed it really is that flat $5 fee. You don't have to pay extra if the ride is a little bit longer to a UPS, a FedEx, what have you. It's not available for us here in New York City yet, so I'm going to have to move to New Jersey to be able to utilize this feature, because I'm online shopping. I am Jay Powell's worst nightmare, Josh, and this is something that you'll learn about.
You are the resilient consumer.
I am it's me in the dictionary, okay? So I need this feature to be able to do all my returns.
Two things that stand out to me. One, it's interesting it's not in New York, and I think the main reason that is because you can't get an Uber for like the low $10 rate in New York, right? Where can you go for $10 here? So for them to give something for $5, if I'm an Uber driver, that would be frustrating for me. You're going to want more of a rate to drive around in the traffic in New York City. So it'll be interesting to see what the demand is from drivers to be able to want to do this, because I believe they can opt in. And then the second part, just go and return your stuff. It's not that hard.
No,
you don't need to pay $5 for someone to return stuff for you.
I hate returning things. It's one of the reasons why I don't online shop as much, because the thought of having to return something is very daunting. And the New York City bit is interesting too, because a lot of us in New York don't have a car. And I feel like if you don't have a car and you don't live close to a FedEx or a UPS, to make that return easier, this is a great option. The $5 fee is amazing, because like you said, I've never been in any Uber that's been less than $10.
No, you can't do anything
Even
for
going
$5
down the street.
No, right. In New York, you can't do anything for $5. Also, to your point, there was a survey I was looking at earlier that showed 40% of Americans would rather sit in bumper-to-bumper traffic than return a package. So we are normal in feeling this way.
I'm not lazy.
We're not lazy. We're completely normal. We're
just
hardworking.
like to spend our time in other ways.
Working.
Exactly.
Going
to work.
So you can spend more money online and then return more stuff.
Exactly.
What a cycle.
I also like to spend my time watching TV, and so do a lot of other Americans, because ABC's The Golden Bachelor hit a new 3-year high for the entire franchise. So this includes The Bachelor, Bachelorette, Bachelor in Paradise. So the numbers here, guys, really speak for themselves. In the 3 days after the premiere, viewership rose to 7.7 million of cross-platform viewing. So that includes streaming, a gain of 3.34 million viewers on streaming, which is almost 77% over its on-air total of 4.36 million. The episode also more than tripled its 18 to 49 rating and was the best 3-day total for any installment of the franchise since an episode of The Bachelorette in November of 2020. And there's that question of whether this is sustainable. Obviously, The Golden Bachelor, it's a new iteration of The Bachelor, older cast. There was certainly an allure, a curiosity of how they were going to lay this out, if it was going to be more wholesome, if we weren't going to have as much of the drama that we're normally used to with this franchise. And then, of course, within the context of the ongoing actor strike in Hollywood, they're currently in negotiations. We just saw the writer strike, and we haven't had a ton of scripted programming out there, not a ton of new stuff at least. So reality TV, really one of the big benefits from, that can benefit from the double work stoppage that we saw. Yeah. But I don't know. I haven't seen it yet. Have you?
No.
No.
I meant to watch it actually. I wanted to watch an episode.
I've seen clips.
So then when I say I don't think it's going to have staying power, then I can always say, well, I watched 30 minutes of it and I don't think it's going to have staying power.
I just think, Josh, there's so many examples of this reality TV group for people who haven't necessarily always been featured on TV doing really well. I think about Queer Ultimatum on Netflix, Golden Bachelor having these incredible numbers. It tells me that there's a market for it. It reminds me of the NFL reaching out to women thing. There's a market for the new consumer that maybe hasn't always been featured.
And do you think people are sick of the drama of the normal Bachelor and Bachelorette? And if this isn't, because I don't think it's going to be that drama filled. I don't think that's.
They can't have the little grandmas and grandpas fighting.
Like you said, so if it is more wholesome, do you think like even the normal Bachelor consumer is kind of ready for that? I could see that, right?
Especially in this age
fighting's
of
gotten a little
social media,
ridiculous.
and like everyone knows people want to be influencers and people want to be this and that. And we haven't seen a ton of great success rates either for these couples. So I think this is a new refresh of sorts. And what you were saying about bringing in a new demographic to the reality TV space, I also think about the people that watch cable television. It's older people. So in terms of perhaps boosting linear up a little bit, this could be a good opportunity as well. Although we are seeing the streaming side doing
interesting.
Well.
If I were ABC, I'd probably want younger people to start watching my network, though. Given all the things going on there.
Yeah, well, Bob Iger's looking to sell it at some point anyway.
Maybe they'll have a new version of The Bachelor with something else coming up, right? We'll have to take a look at that. But there'll be more Yahoo Finance Live on your other side while we go and watch The Golden Bachelor during the break.
Shares of Clorox trading lower. That's after the company came out with preliminary financial information for the first quarter. The company now expecting a quarterly loss, and it all has to do with the cybersecurity attack that happened in August. Clorox says the cyber attack, quote, more than offset the benefits of pricing, cost savings, and supply chain optimization. The company says as a result of this, net sales are going to fall by 28 to 23% from the year earlier quarter, Josh.
Yeah, and the group of hackers is apparently the same one behind the attacks we saw in the big casinos recently. So Caesars and MGM, and Bloomberg is saying the group here called Scattered Spider is responsible, believed to be comprised of 5 to 6 core members operating in the U.S. and the U.K., and they are being investigated by the FBI.
So we didn't know prior to this what the actual monetary effect of this was going to be, and so now getting this updated. The company also says gross margin is going to fall compared to the year-ago quarter. Prior to this, the company had said gross margin would rise. So this really does seem to be weighing on the company. It says it will experience ongoing but lessening operational impacts in the current quarter as it tries to get back to normalized operations here. You know, for years, we have talked about the perils of these hacking operations, and it feels like that there have been sort of isolated incidents that have had effects like this, but you know, we should check in and get some figures onto whether there's actually, not just anecdotally, whether there has been an uptick in events that have a material impact like the one that we're seeing.
Yeah, I mean, listen, every C-suite thinks about this risk and how to defend themselves against it. In some sense, you're kind of playing whack-a-mole. For Clorox, though, here, you're dealing with these headlines, you're dealing with this business challenge, the risk here that, you know, you begin to lose share to peers and rivals as you deal with it, obviously.
Yeah, definitely. Clorox shares, by the way, down about 6% year to date, in part as investors are watching this situation. It seems the sweet spot for a healthy shopping mall is a Cheesecake Factory. According to new research from Moody's Analytics, shopping centers with the restaurant are more likely to pay their bills on time compared to those who don't. The author of the note, Moody's Director of CRE Economics, Matt Reedy, is joining us now. And Matt, got to give you big props for the title of the note, which is an allusion to Mean Girls. Get in, loser. We're going shopping. You know, which is, I find so fascinating because, like, the death of the American mall has been talked about for decades, it feels like at this point. It ain't dead, right? And I guess it especially ain't dead if there's a Cheesecake Factory in the mall. Like, what's the connection here?
Yeah, so, I mean, to some extent, it may not necessarily be that the Cheesecake Factory is driving the performance of the mall as much as it is that their real estate team does a great job of selecting locations. So there's definitely a correlation there, and we see you see it in the numbers that get there. You know, at the end of the day, though, it's great performance for properties that have a Cheesecake Factory.
So some of this, Matt, could be just, listen, the Cheesecake Factory's team does a really good job at spotting the right malls. But you took a look in this report at just the state of malls, also more broadly, Matt, the health of regional malls. What did you find?
Yeah, so on the whole, the big factor that plays into the success or failure of a mall at this point in time really comes down to the mix of tenants that they have. Having, in the last segment, they talked about what a hassle it is to return products that you buy online. And one success factor for malls is having retailers that are really good at the omni-channel strategy, where they sort of tie the in-store experience together very well with the online experience. So if somebody into the physical location to return it. Other things that contribute to a really strong performance, are things like restaurants and other types of entertainment venues. And fortunately, or I assume fortunately for most people, if they're like me with Cheesecake Factory, another location that we see popping up at a lot of malls now are fitness centers, which you're going to need if you eat much of that Cheesecake Factory.
Matt, is there something we can put together and say, well, the companies that own the highest proportion of these types of malls are? Like, are there, sort of A mall owners that will then fare better as a result of this? Oh, unfortunately, I think we lost Matt's connection there. Matt Reedy from Moody's, we will have to check back in with him another time to get some good REIT names in the mall space. Coming up, closing time here on Yahoo Finance. We're going to recap the top stories of the day, get you set for everything you need to know tomorrow. Keep it here. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It is closing time here at Yahoo Finance. So let's get you caught up on some of the stories that we're watching here as we close things out. Disney offering limited time discounts on children's tickets to Disneyland and Disney World as it tries to boost attendance. Starting on October 24th, you can buy tickets for kids ages 3 to 9 starting at $50 a day. These tickets can be used between January 8th and March 10th of next year. Walmart, the latest company, warning about the effect of the soaring popularity of weight loss drugs. In an interview with Bloomberg, Walmart's head of U.S. operations says the drugs are causing a slight pullback from shoppers. The retailer is studying changes in sales patterns using anonymized data on shopper populations. And now that the writer's strike is over, Saturday Night Live is announcing its return date. Pete Davidson will be hosting the show on October 14th with Ice Spice as the musical guest. The entire cast from last season will be returning.
And here's what to watch on Thursday. In the morning, we will get initial jobless claims. The expectation is that 210,000 people filed for first-time jobless benefits, up slightly from the prior week. That would mark another sign that the labor market is cooling, which is something the Fed is looking for in its fight against inflation. It also comes ahead of the big jobs report, of course, on Friday. Estimate there is 170,000 jobs added, and the unemployment rate edging down to 3.7%. Also, before the bell, we're going to get earnings from the owner of Modelo, Constellation Brands. And Constellation Brands CEO Bill Newland, by the way, is going to be joining Yahoo Finance on Friday. Levi's and Conagra also set to report earnings. And at 12 p.m. Eastern, Freddie Mac will be out with its weekly reading on mortgage rates, with the 30-year fixed closing in on 8%. We'll be taking a closer look at the state of the housing market with Redfin CEO Glenn Kelman at 3:30 p.m.
So apparently, I don't know how to say the word anonymized.
It's not easy.
It's one of those that I've read.
Very easy to trip up on.
I don't know that I've ever said out loud.
I don't judge you for it.
Anonymized. Took me a second. All right. The more you know. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage of the best business and finance stories. Have a great day, everybody.